Welcome everyone in the Pile Investing Personnel Finance book series, where we bring you the famous award-winning author publication on investing and finance well-being. Today, the book we are going to be discussing is Learn to Earn book by Peter Lynch. Peter Lynch, born on January 19, 1944, is a legendary American stock investor and businessman. Lynch managed the Magellan Fund and generated a stunning 29.2% annual return over 20 years. A well-known book written by Peter Lynch is Learn to Earn, a beginner's guide to the basics of investing and business. He goes over things like reading financial statements, assessing equities, and investing in the significance of economic cycles. Learn to Earn is a great place for people to start if they want to become more financially knowledgeable and make wise investing choices. I divided book into 10 takeaways. Takeaway 1: Assets versus liabilities. Imagine starting your first job and having some money to spend. It's exciting, right? But before you go splurging on a fancy credit card or a luxurious car, let's think about smart money moves. Credit cards are useful, but using them like a never-ending loan can lead to big interest fees. For example, if you buy a $1,000 gadget and pay only the minimum each month at an 18% interest rate, it will cost you $539 in interest over 5 years, making the total cost $1,539. Now about that flashy car. It may seem like a status symbol, but is it helping your wallet? According to financial advice, assets make you money, while liabilities drain your money. A car loan, with its monthly payments, fuel costs, and maintenance, is a liability eating away at your money. Most millionaires drove less expensive domestic or second-hand cars. Financial wisdom starts with understanding assets and liabilities. Focus on creating income-generating assets first instead of piling up debts. Once your assets start making money, you can think about treating yourself to those non-essential luxuries guilt-free. In short, make your money work for you by investing wisely and spending smartly. That's the key to building wealth and achieving financial freedom. Takeaway 2: Start building assets. Imagine you have different ways to make money. Some are active, like working for a salary, while others are passive, like investments that earn money on their own. These passive income sources are like monopoly properties that pay you rent without you having to do much. Examples of passive income assets include stocks, bonds, art, intellectual property, precious metals, and real estate that generate income. Financial independence means being able to live comfortably without relying solely on a job. It's like having enough money to live in your dream place and do what you love, even after retirement. To achieve this, you need to build a collection of income-generating assets. For instance, if you need $50,000 a year to live well in retirement, and your assets can make a 10% return annually, you'd need around $500,000 saved up to support your lifestyle. Thinking ahead, if you start building these assets early, you might be able to quit your job earlier and pursue your passions. It's all about planning and making your money work for you in the long run. Takeaway 3: Power of compound interest. What if, as in a fantasy novel, money could grow magically over time? Compound interest works similarly to strong magic to enable the growth of your funds. Let's say you start investing $500 every month when you're 35, and this money earns 8% interest each year. By the time you're 45, you'll have about $87,000. But if you start investing the same amount at 20, by the time you're 45, you'll have over $435,000. And if you invest $2,000 every month starting at 20, you could have a whopping $1.75 million by 45 without taking any money out. This shows how starting early and letting your money grow over time can lead to big rewards. On the flip side, when you don't pay off your credit card balance in full and let the debt accumulate, compound interest works against you, making it harder to pay off. So, it's important to understand the power of compound interest. Takeaway 4: Delayed gratification. Consider being forced to decide between investing and saving money for the future or spending all of your money on luxury today. That is the importance of delayed pleasure. Let's say that person A and person B both make $5,000 a month. Person A spends immediately on fancy items. Person B spends wisely and invests $2,000 monthly in an asset growing by 8% annually. After 5 years, person B has $140,000 saved, generating $1,000 monthly in passive income. Person A, without savings or investments, has no passive income. This shows delaying gratification and wise investing can bring financial security and future luxuries. Instead of spending everything now, practice self-discipline. Invest in assets for stable future income. This way you enjoy life and secure your finances. A small request before we proceed. Please remember to like the video and subscribe to our channel. Your support helps us create more helpful content for you. Takeaway 5. Fear and greed. When dealing with money, two extremes can be harmful. Uncontrolled desires leading to greed and the fear of losing money. Greed pushes us to want more than we need, while fear can hold us back from taking smart financial risks. Investing without understanding can be risky, like gambling. However, with financial literacy and risk management knowledge, investing becomes a wise decision rather than a gamble. The key is to be self-aware and emotionally mature about money matters. Stick to your financial plan even amid hype while earning a higher salary is beneficial. It's crucial to use that money wisely by creating income-generating assets instead of accumulating more liabilities. Takeaway 6. Risk versus reward. Different ways of investing come with different levels of risk and potential rewards. 1. Savings account, low risk, low reward, 2% interest. 2. Bonds, low risk, moderate reward, 5% interest. 3. Stocks, higher risk, potentially higher reward, 10% return. 4. Gold, moderate risk, potential for gain or loss based on market fluctuations. 5. Investing in a friend's startup. High risk, potentially high reward, but also the risk of losing all your money. Younger people can take more risks because they have time to recover from losses and benefit from compounding growth. For instance, if you are 25 and lose money in a high-risk investment, you have time to save again and learn from the experience. Someone nearing retirement might choose lower-risk investments to protect their savings because they do not have as much time to recover from losses. Takeaway 7. Asset classes. Some of the various types of assets you can invest in. 1. Shares, stocks, buying a share of a company's ownership. 2. Bonds, investing in debt issued by companies or governments. 3. Real estate, investing in property for rental income or future value appreciation. 4. Commodities, investing in raw materials like gold, silver, oil, etc. 5. Art, antiques, investing in artworks, collectibles, or specialized funds related to art. 6. Cash, maintaining liquidity for immediate investment opportunities or currency trading. Shares represent ownership in a company and offer high returns, but also come with higher risk if the company does not perform well. Real estate can yield rental income and property value appreciation, but requires initial investment and maintenance costs. Commodities are raw materials that can be traded, but are influenced by market fluctuations. Investing in art or antiques can be driven by passion and has potential for appreciation. Takeaway 8. Your intellectual property, an asset. If you have specialized knowledge that can be turned into intellectual property, such as patents or copyrights, you can create passive income streams. You can start monetizing your knowledge at any stage of life. It's important to invest in asset classes that interest you because it helps you develop expertise and make informed investment decisions. By immersing yourself in a specific asset class, you gain the competence needed to invest wisely and enjoy the process of growing your wealth. Diversification. It's wise to invest in different asset classes like shares, bonds, real estate, and commodities to reduce risk. Within each asset class, diversify further to spread risk. For example, if investing in shares, buy stocks from both developed and emerging markets or consider a mix of large and small companies. Cost averaging. Instead of trying to time the market by predicting highs and lows, practice cost averaging. This means spreading your investment purchases over time to average out the total cost. This strategy helps reduce the impact of market volatility on your investments. Takeaway 9. Risk management. Stock picking and brokerage. If you're confident in picking stocks and bonds, you can trade through a broker or online platform. Consider fees and minimum investments, mutual funds. These pool money from investors to invest in various securities. They offer choices like open-ended, close-ended, fixed income, and equity funds. Understand costs like entry, exit loads, management fees, and turnover. Index-linked mutual funds. These mimic market indices, offering a passive investing approach with lower costs compared to actively managed funds. Exchange-traded funds, ETFs. These track an index or assets like a stock but trade on exchanges. They have lower costs and offer diversification. Real estate. You can invest directly through agents or developers or indirectly via real estate investment trusts, REITs, real estate mutual funds, or real estate ETFs. Commodities. Invest in mutual funds or ETFs related to commodities or directly purchase commodities like gold or silver. Each investment type has its risks and rewards, so it's crucial to understand these factors and choose investments that align with your financial goals and risk tolerance. Takeaway 10: How to invest. Creating a financial plan is a crucial step toward achieving your financial goals and securing your future. Here are some of the steps involved in creating a financial plan. Evaluation. Assess your current financial position, including income, expenses, savings, investments, and taxes. Identify your life aspirations, such as generating passive income, buying assets, and planning for major life events. Budgeting. Compare your income and expenses to determine if you have a surplus or deficit. Trim unnecessary expenses. Consider creating an emergency fund for liquidity and peace of mind. Investing. Invest in assets or investments that align with your financial goals and risk tolerance. Choose asset classes based on your life situation, investment horizon, and risk appetite. Protection. Evaluate if your income, investments, and assets are adequately protected. Assess insurance needs for life, disability, health, property, and liabilities. Ensure financial protection for dependents in case of your death or disability. Retirement and estate planning. Determine your retirement timeline and plan for early retirement if desired. Review retirement savings, pension plans, and investment strategies for long-term financial security. Regular review. Conduct an annual review of your financial plan. Evaluate the performance of your investments, reassess risk tolerance, and adjust asset allocation as needed. Update your financial plan based on changes in personal circumstances, financial goals, or economic conditions. By following these steps and regularly reviewing your financial plan, you can work toward achieving financial stability, meeting your life goals, and securing your and your family's future. That wraps up the world's best personal finance book lessons. I hope it will help to make your financial decisions better way, and ideas will help improve your life. Be sure to subscribe to our channel Pile Investing for more learning and growth opportunities. Until next time, goodbye.